all of you. I think it is 11 o'clock. It's a time for us to start the webinar. I have a great pleasure in welcoming you all to the weekly Saturday knowledge sharing session by Mehta Mehta. I extend my heartfelt welcome to all of you on my own behalf and also on behalf of Mehta Mehta. Today is actually our 7th and the last session on the NBFC series, which we have been discussing for the last 2 months or so. Mr. Hemant Pandya and Vishal Solanki, both of them from JM Financial Corporation, who has been with us in most of these sessions. You are all very familiar with them. Similarly, Shanmugh Sundaram has also been associated with us, and he has been present in a number of webinars, and he has been there in this series also, who's coming from the Coromandel, which rich experience, which also we are familiar, but nevertheless, I will do my duty of giving a short introduction to them. And this time we have another expert in the field who's coming from. So Mukut Fincap, she is actually here. She also coming with a greater experience, one of the NBFC associated things. So all these experts are going to definitely share a lot of their knowledge. Let me first introduce our panelist, Hridaya, who's actually coming from Mukut. She's a company secretary over more than a decade of years of the services in the compliance management corporate secretarial function. And she is working as a chief manager and assistant company secretary in the Mukut FinCap. Is one of the very leading, the top layer non-banking financial companies in India. You are all aware. They have almost about 3,700 branches across the country, which is very familiar. It's one of the very flagship company. And they have a diversified business and a lot of activities, etc., related to NBFC. I'm very sure she will be definitely sharing her personal experiences and the things, etc., related. Today's subject is going to be reporting of NBFC companies. And along with that, we are also going to discuss the draft rules, which has actually come up on a related party transaction. Although the related party transaction already there relating to sanction of the loan, etc., and other thing already. Now, you know what happened? The related party is actually acquiring more and more importance under the Companies Act and as well as also the LODR regulations. Similarly, here, the NBFC, they also came out with the RBI. They came out, it is actually a draft regulation. Today, it is not applicable, but it will become applicable from the next year, actually, onwards when it comes. That also we are going to take it up today. One more thing is there at this particular time, we are discussing only the RBI related NBFC regulations. So wherever the NBFCs which are actually listed, they are not also comply in addition to whatever the RBI regulations applicable as per the licensing procedure for the NBFC company. And the listing regulations, specifically today as a related party transaction, etc., where the LODR has specifically come out, what are the information should be put up to the audit committee, etc., that they'll have to comply. In over and above that, that is not a subject matter we are going to take so much, but we are concentrating only the RBI. Now let me go to our next panelist, Hemant Pandya. Hemant Pandya is coming closer to 2 decades of the rich experience in the secretarial compliance and the legal functions actually. In fact, he is currently with the JM Financial Group and he is serving as a executive director on the compliance and legal and corporate secretarial. And in fact, he was with this Mehta Mehta for a short stint, who was actually working in a practicing company secretary. That is how our association with Mehta Mehta is very much familiar with him actually. And he also comes with a very rich experience in the NBFC dealing. He has been sharing his practical experiences in the past. And today also we look forward him, his better experience sharing on the related issues. And in fact, he has been conducting several training sessions and he is contributing a lot of things as our institute's initiative, etc., which he has been actually doing it. So we move to the next panelist, Vishal Solanki. He also comes from JM Financial. He is actually a chief financial officer. As you are aware, chief financial officer is recognized as one of the KMP and who is actually playing a larger role. Because whatever we talk in terms of, whatever the plan, whatever the things we talk about, ultimately everything which is converted in terms of money, what is that figure? Sabse bada rupaya. So that is where he is there. So he has got the very greater responsibility in assimilating the things, putting the things, coming out with the fair and true view, which will be open for the independent audit. That is one thing. And second thing, he has been actually having a very rich experience in the financial planning and budgeting, and finally takes the accounts and taxation related matters. And besides the regulatory compliances which are required under this, so he is also coming from this organization. And we are very sure he will have his benefit like in the past. He will definitely share his richer experience. Then we move to the next panelist, Shanmugha Sundaram. Shanmugha Sundaram, as you are aware, he is actually our fellow member of the Institute of Company Secretaries, and he is also a registered insolvency bankruptcy board of India, and he is also holding a master degree in LLM actually. And he has come from the Coromandel. And I don't have to give much of his introduction because you are all aware he has got more than 2.5 decades of the experience in the banking and the NBFC operations, and also specifically on CSR related issues. And he is also a CII certified CSR professional, actually coming with the various compliances, legal governance, and secretarial matters. Vast experience will have his benefit. Next, we move to our presenter. Our presenter is actually Kinjal Mehta. She is actually having a dual qualification, chartered accountant and company secretary. And she has been actually working with the E&Y, one of the big four auditing firms and the assurance auditing prominent private sector of the banks. And she has also contributed a lot of merger and amalgamation related issue. And she is actually got the training under the E&Y strategy and transaction and the advisory term. And she has also worked with the Block Soil Capital, a venture debt fund undertaking the investment and the growth companies. Currently, she is actually a senior associate in Mehta Mehta, and she is associate with the IPO team. And she is going to make a presentation. And as we go along, she will share the various presentation, reporting, etc. as we go. I think I will not talk anything about today's subject because I leave it to the panelists. We have the expert in the field to say they will talk about today's subject, their importance, etc. And only my request is to all of you, as usual, you put up your queries and questions and clarifications in the chat box. We'll be taking, as per in the past practice, that and there, and we'll be answering. We'll seek the clarification from the panelists. Of course, at the end of the session, you will be permitted to raise your hands. You can speak. You can get clarified whatever the things there. I will actually start with Mr. Shanmugha Sundaram, who's coming from the Coromandel, to share his thoughts on this subject first.
Yeah, thank you, Mr. Bala. Thank you, Mehta and Mehta, for this opportunity. From the NBFC's standpoint, is one of the very important. It is one of the very important, topic. See, from the RBI, it is these reporting requirements are for the effective regulation and supervision of NBFCs. It helps our RBI to monitor the financial health and compliance, as well as the risk to which the NBFCs are exposed. It also helps RBI to maintain oversight, enforce discipline, as well as to ensure that NBFCs perform according to the requirements of the financial sectoral needs. So these are the objectives of these returns. These are not mere filing exercises by the NBFCs. These provide a lot of inputs to RBI in terms of regulatory oversight, financial monitoring, then risk management, then data for policy making, of course, for enforcement of compliance, because there are various directions issued by RBI. So from that standpoint, this is a very important topic. I hope this session will be useful to all the attendees. Yeah, over to you, Mr. Bala.
Thank you, Shanmugha. I'll request Mr. Hemant to share his thoughts on this topic.
Good morning, everyone. It's a pleasure to be part of this masterclass series and to join today's panel. First, I would like to extend my sincere thanks to Mehta and Mehta for organizing this webinar, especially a webinar series especially focused on NBFC, which is such a critical and dynamic space for professionals like us. The depth and relevance of the topics that we covered so far have been truly enriching. And I have been personally, learned a great deal from, from the distinguished panelists who have shared their insights across the sessions. Over the past few weeks, we have seen how the regulatory NBFC framework is evolving, not just in scope but also in by intent. RBI has proactively refined, its approach, drawing from learnings and global practices, while also keeping so the scale-based regulation framework, if you see, this is, in a structural, proportionate way, like small, then medium, then large, and clarity to the and has given a lot of clarity to supervision. What's exciting is that this evaluation is creating new opportunities for professionals like us to contribute meaningfully to build stronger institutions and to stay ahead of the curve. So whether you are from NBFC background or exploring the new space in this NBFC, I believe the recorded sessions, which are available on Mehta and Mehta, will offer you a rich, practical resource that's accessible to all. Today, as Sir introduced, we are going to talk about two things, which is NBFC reporting and draft regulatory framework on RPT. So, regulatory framework, as Shanmuga Sir also said, is becoming more, it's very important. And, it's something, which is, the data that we give is something that is representing the company, NBFC, and for RPI, the whole system at large. So that is how they track where NBFC is going, and what needs to be done. So it's becoming more data driven, real time, and aligned with global standards. And our draft RPT framework that we are going to see is something, a forward looking initiative to strengthen corporate governance and to ensure fairness in intra-corporate transactions. Though there are some stringent things, but it is open for public domain, public comments, which I believe people will be representing. Both topics reflect the regulators' intent to build a resilient, transparent, and accountable NBFC sector. I look forward to sharing my thoughts and learning from the perspectives from fellow panelists also. Just a small disclaimer: me and Vishal, are going to speak today. Those are entirely our own views and do not represent the views of our organization where we are associated. Yes, sir. Thank you.
Thank you. Over to Vishal Sadhan, please.
Hi, good morning, everyone. Thank you very much, entire team and team Mehta and Mehta, to invite me as a panelist. Today's topic is very exciting and good, which is insight into the NBFC reporting and the draft regulatory guideline. So first, I'll touch upon the reporting requirements. So as we are aware that there are NBFC categorized into the four buckets, which are like base layer, middle layer, upper layer, and top layer. Each NBFC has their own set of requirement to report to the NBFC in the form of returns, which are in the different frequency in terms of time. Like few are weekly, then fortnightly, monthly, quarterly, and few are 1 or 2 are on the yearly basis. Obviously, during the year, the NBFCs need to file the returns, which are provisional in nature throughout the year, because numbers are provisional. At the year end, after they complete their audit, there is a requirement that within 5 days they need to file the audited return, which is a change recently, because before few years RBI had given 1 month, but which since last 2 years they have shrink the timeline from 1 month to 5 days. The returns the NBFC file are mainly in the two portal, which are, one is the CIMS portal and second is on the Daksh. And returns mainly cover a lot of financial and non-financial parameters, like your concentrations, exposures, your asset classifications, your group, non-group informations, all those things. So basically, the intention behind all the returns is one is monitoring and second is the statistical information for RBI also, where they come out with the, say, kind of industry average things, and they come out with if any of the NBFC has any outlier in terms of any asset quality or say any other parameters. So this thing. And the second topic we are touching here is the related party, which is at the draft stage. So in the in the new guideline, they have just expanded the definition of the related party, and they have increased the threshold to do the transaction with the related party. Like for the middle layer is 5 crore and the base layer is for the 1 crore, and the upper layer is then 10 crore. Beyond threshold, also they have allowed to do the transaction in the draft, but with the permission of the board or the board appointed committee. Uh, uh, Basically, after this guideline, what my understanding is the each NBFC has to amend their lending policy where they need to have the specific paragraph on the related party transaction mentioning the limits and sub limits. And apart from this, they have come out with the semi-annual requirement to file the returns, which I think earlier it was not there for the related party. And there are some disclosure also they have mentioned. So apart from this, they have mentioned that those companies which are listed already, they need to continue to follow the SEBI LODR also for the RPT. So which is the intention is to move in line with the evolvement in the industry where the credit growth and everything is going on. So this is very good move in terms of me. We will see more things during the presentation, and I'll keep adding my views during the presentation. Thank you very much as of now, and look forward to participate more during the presentation. Thanks, sir.
Thanks a lot. I request Hridaya to share her thoughts on this.
Thank you, sir. First of all, I would like to thank Mehta and Mehta for this opportunity. So I have been part of many of these NBFC webinar series that has been conducted. It has been really an enriching experience for me as a professional. In this regard, I would like to draw your attention to the fact that since this SBR framework has been introduced by RBI, there are many changes in the compliance landscape that is happening in a fast pace. This RBI has introduced many circulars, master directions on, like we can say, risk-based internal audit, IT governance and practices, fraud frameworks, co-lending, and like outsourcing of information technology services. So many guidelines, many master directions has been coming up, and the pattern of RBI inspections has been changed in the last 2-3 years. That is the experience we have in our organization. And here the assurance functions in the organizations like risk and internal audit, the compliance, they assume a greater role in an organization. So they act as an extended arm of the like they're acting as an extended arm of the regulator only, ensuring that all the regulations has been practiced in true letter and spirit within the organization. So the topics covered here is very broad topic, and here we are also summarizing the points that we have covered in the previous webinar also. So I'm looking forward to an enriching experience here, and one thing I would like to assert that whatever views I'm expressing here is my own personal views, and I'm attending this webinar in my personal capacity and not as a representative of this organization. So looking forward to an enriching experience. Thank you, sir.
Thank you very much. People have talked about the draft regulation which is being proposed for the RPT. In fact, the whole idea of the RPT regulation is they probably wanted to bring the harmonization and the structured reporting. And in fact, there is a format is also being introduced by the RBI actually. And this is already there in the public domain. In fact, the public comments are actually invited. I think the time is given up to 31st October, I believe, actually, wherever they can give the comments, etc., and other thing and all, because they probably wanted to bring, what you call more consistent principle-based framework, especially in case of the lending to related party. That is the whole idea of it. As I said earlier also, is going to come only from 1st April 2026. Till then, the current things will actually continue to be there. So we can hope definitely, because most of the things, whatever seen in the past, whatever the scam, scandal, etc., most of the things are emanated from the related party transactions only. Because money have been siphoning of the money, etc., everything has happened because of the related party. That is why they wanted to bring in line with the related party, strengthen the thing in the interest of the protection of the investor. That's what it appears to be. As we go along, we'll actually see this. Okay, over to Kinjal. You can start your presentations, please.
Yeah, thank you. Hi everyone, good morning. This is our last session for the NBFC webinar series. And in today's session, as already mentioned, it's divided into three parts. One is on NBFC reporting. The second is the draft regulatory framework on related party lending. And the third one is a quick recap of all the six sessions that have already taken place before. So starting with RBI filing of supervisory returns directions 2024. This was issued to kind of consolidate fragmented reporting requirements for different types of NBFCs and different, timelines that were there, which was very confusing, and some of it was obsolete, some of it was overlapping. And there were several circulars that was covering it. So so RBI came out with this one consolidated direction in 2024 that essentially consolidates all reporting requirements for these NBFCs. This was just to improve risk monitoring, and for RBI's purpose also to gather proper data and group level supervision, benchmarking, and a more consistent analysis throughout the NBFC sector. So now these directions are applicable to all commercial banks, excluding rural banks, commercial banks, all primary urban cooperative banks, all India financial institutions such as Exim Bank, NABARD, NHB, SIDBI, NAB, FAIB, all NBFCs excluding housing finance companies, and all ARCs. And all of these requirements are for all domestic as well as overseas operations. Now, since our focus is on NBFCs, I'm going to be covering all reporting for NBFCs only and not commercial banks and other institutions. So starting with RBI starts off giving us broad guidelines on the responsibility of the board and the senior management. So the responsibility of board and senior management is, ultimate when it comes to all the data that is reported and all the reportings that actually go to RBI. The board and senior management is responsible to ensure risk data aggregation and reporting processes are fully documented and validated by staff with appropriate IT experience, and adequate resources are deployed to this particular function. They also need to undertake data quality and ensure that there's a risk framework in place. So they need to incorporate data quality risk into overall risk management, establish standards for in-house and outsourced data processes, include policies on confidentiality, integrity, and availability, which is extremely important when it comes to such sensitive data. Then, when there is any merger, divestiture, any kind of restructuring happening, or a new product or new IT initiatives that are being introduced, it is required to evaluate and integrate data aggregation and check the impact on the reporting into the existing works within the set timelines, and see once this change has taken into place, all the reporting has also been consolidated after the restructuring. It also highlights data consolidation across structure, with group companies having several NBFCs. It must ensure that ability to aggregate and report data at all levels, entity, group, jurisdiction, in case of overseas entities, and is not hindered by organizational or geographical structure. So to ensure that there's a consolidated reporting structure and processes in place throughout the group. The circular also highlights data architecture and IT infrastructure that is required. It is imperative that robust IT and data systems are in place. So these are designed and maintained, in a data architecture and IT systems that ensure accurate, complete, and timely reporting in both normal and crisis conditions. They also need to have a business continuity plan and ensure that there's integrated data aggregation and reporting processes that are there to allow business continuity, and check if there is any kind of crisis situation, how does that impact, and check for business impact analysis plans.
There is someone has actually referred on the ITIS. Here actually Satish is actually saying RBI wants us to undergo a ITIS audit from the external service provider, not in-house from the internal audit team. Is it the same practice to be followed for all the middle and upper layer NBFCs, or can the head of the internal audit, who is also a CISA certified, as this, and the RBI is not actually certified, where head audit is into execution? And Hemant, what is your view on this? Is it RBI want the automation of these returns? How to do about it? If any vendor or service provider who actually have outward of the turnover automations. This is the question he's asking related to ITAS.
Sir, generally, I don't remember there is any restriction, but what RBI wants is that there should be an external independent auditors for NBFCs doing this kind of audit with a proper specific background from there for doing this IS audits. And uh, there are many cases where RBI informally also while during inspection, and also they check whether the audit which has been conducted is with proper independence, and with proper CISA certified auditors. So that's my view here. Shanmugh, I want to add something on this.
Yeah, Shanmugha, what do you say on this?
Yeah, see, as per the master directions on IT framework, there is a requirement to do an IS audit actually. This has to be done by an external agency. And the report of the audit report has to be put up to the audit committee, and audit committee has to recommend it to the board actually. That's how the process as such was actually. So from the RBI perspective, they also look at this audit being done by an external agency rather than an internal, because the external agency does a lot of vulnerability assessment testing, how the systems in the NBFCs are robust enough to prevent or withstand any hacking and all that. So generally, by middle layer and upper layer, it is done by an external agency. They don't accept any report by the internal auditor as such, actually.
But any particular software is actually available on this or something? Any external agencies are actually providing, whether we can, ask them to do on our behalf, or we can do any such things are there like that?
No, external agencies have got various tools to understand, to assess whether the systems can be, withstand the ransomware attack, hacking, how they do the penetration testing as well, actually. So they have all the tools, and they do give a very detailed report in terms of they have certain parameters. So they do assess based on those parameters, and they give a very detailed report actually.
But one thing is there, whatever it is, whether it is the external agency, otherwise ultimately the responsibility and accountability remains with the NPS.
Yeah, that is the thing.
Because they cannot say somebody is certified and I relied upon that sort of a thing cannot work actually.
See, as a security measure, what some of the NBFCs do, during the night time, they do shut down their, servers actually. They do, block access to the servers even for the employees.
Okay.
That's one of the security measures which some of the NBFCs undertake.
So RBI has a separate circular itself when it comes to IT infrastructure and audits and requirements, which we have touched upon in our previous sessions. Whereas in this particular circular on reporting, it just gives a broad guidelines in terms of how it should be maintained. Then they also talk about accuracy and integrity in reporting to ensure that all the data that is fed into these returns that ultimately go to RBI is all accurate, and when it comes to different entities in a particular group, everything is in sync and correct, accurate information is going into these returns. So they must reconcile all returns to see that the same picture is being depicted in all returns, and reconcile all regulatory returns and risk reports with internal data sources, including accounting data, to ensure accuracy and completeness. RBI is also appreciating data automation for high levels of automation in data generation and return filing to minimize manual intervention and errors. Then also, it is very much required to maintain the data source documentation and aggregation logic and transformation rules used in return preparation. How the data is being prepared, which is being fed into the returns that ultimately go to RBI. Then it is very much required to monitor the quality of data that is being generated within the organizations. So to establish systems to measure and monitor data accuracy with clear escalation processes and corrective action plans for quality issues. Now, the filing of the returns, before, like I said, it was very fragmented. There were many different deadlines, timelines for different types of NBFCs, different types of returns. Now, this circular, this new change essentially has given a fixed periodicity for different types of returns, being weekly, fortnightly, monthly, quarterly, half yearly, and yearly. And the timeline for whenever this kind of periodicity is mentioned is given basis a reference date. Now, for example, for weekly, anywhere where a return that is needed to be filed weekly, the reference date would be Friday, and the timeline that is given is before Wednesday of the following week, or for whenever there's a fortnightly return, you have 15th and last day of the month, which is 28, 29, 30, 31st, and within 7 days from the reference date. And same way for monthly, quarterly, the timeline is given with reference to the reference date, which is the last date of, say, the month, the quarter, the half year, etc. Now, there are certain cases where alternate timelines are mentioned. This will be covered later in the presentation. Now, all of these returns are mostly filed on the Daksh portal of RBI. Before this, there was Cosmos, there was individual emailing and manual filing. All of that is now being replaced by the Daksh portal, which was introduced in January 2023. It is more centralized supervisory reporting, and it's used for all types of regulatory filings with RBI when it comes to all NBFCs and banks. Now we dive into the returns that are filed by the NBFCs with RBI on this portal. So one is the DNBS 01, referring to important financial parameters, filed quarterly. NBFC upper layer, middle layer, except for NBFC CICs. This return contains components of assets and liabilities, profit and loss account, exposure to sensitive sectors, sectorial credit, etc. Then we move to DNBS 02, which is important financial parameters for base layer NBFCs, which is filed quarterly. And this excludes NBFCs, P2P NBFCs. This return contains financial details, which includes components of assets, liabilities, profit and loss account, etc., as well as for complying with various prudential norms. DNBS 03, pertaining to important prudential parameters. It contains prudential norms related data, which is filed quarterly for upper layer NBFC, middle layer NBFC, except for CICs. It also includes data on capital adequacy and provisioning requirements. Then you have DNBS 04A, which is short-term dynamic liquidity, and it's filed quarterly for various types of NBFCs, including upper layer, middle layer, except for primary dealers, base layer with asset size of 100 crores and above, or at group level. And this excludes type 1 NBFCs and non-operative financial holding NBFCs, P2Ps, As, and mortgage guarantee companies. There is a part B to this, which is filed monthly, which again is structural liquidity and interest rate sensitivity. And it is filed for upper layer, middle layer, base layer, with asset size of 100 crores and above. Solely or at group level with certain exclusions, with the same exclusions. Now, these two returns contain data on asset liability mismatches and interest rate sensitivities, include and liquidity risk exposures. So this is essentially liquidity management returns that are filed with RBI on quarterly and monthly basis. There's DNBS 07, which is filed by ARCs for important financial parameters. It contains data on assets, liabilities, assets acquired from banks, financial institutions, acquisition costs, trust firm recovery status of acquired assets, etc. Then you have DNBS 08, which is CRILIC main for NBFCs, filed monthly by upper layer, middle layer, except for CICs, and base layers, which are NBFC, ICC, NBFCs, MFIs, NBFC factors having asset size of 500 crores and above solely or at group level. Now, this return contains certain credit information in respect of borrowers who are having aggregate exposure of 5 crores and above with NBFCs. In case any entity to whom the return is applicable does not have any borrower with aggregate exposure of 5 crores and above for a reporting month, it shall submit a nil return.
Oh, that means nil return is actually required to be submitted. Because
Yes.
many of the places, if the nil return is there, I think other regulatory authorities, they don't need the nil return. But here it appears to be specifically nil return is required to be submitted.
Right. So there may be times when, there may be certain months where there is no such exposure. So for those months, a nil return is filed. Otherwise, for other months, the return needs to be filed. Then we have NBS 09 CRILIC RDB return, which is filed weekly by upper layer, middle layer, except CICs, base layer, which are NBFCs, ICC, MFIs, factors having asset size of 500 crores and above, solely or at group level. NBFCs may report certain information on large borrowers having aggregate exposure of more than 5 crores and above with them, who have defaulted during a week or moved out of the default position through this return on each Friday. In case any entity to whom the return is applicable does not have any large borrower with default move in, move out positions during the week, it shall submit a nil return. So this is essentially for, any large concentration borrowers which have come into default or moved out of or have regularized needs to be recorded on and reported on weekly basis with RBI. Then you have DNBS 10, which is Statutory Auditor Certificate return, which is filed yearly within 5 working days from the date of signing of auditors, not later than December 31st of the same year. And this is applicable for all NBFCs and ARCs. All NBFCs and ARCs shall enable the statutory auditor to submit DNBS 10 statutory auditor certificate return every year. The certificate shall be based on audited books of accounts of applicable entity for preceding financial year. The statutory auditor shall compile, generate, and file the return using the secure login credentials created by the applicable entity. So this is statutory audited, return for statutory auditors that is to be filed on annual basis. And this has to be once the statutory auditor is appointed, basis the requisite procedure. The requisite approvals have been taken from RBI. Once the statutory auditor has been appointed, does this return come into play? Then you have DNBS 11 with CICs regarding important financial parameters filed quarterly, applicable to CICs only. The return contains data on asset and liabilities, profit and loss account, exposure to sensitive sectors, and sectoral credit. This is a requirement on sectoral data for these CICs. Moving on to DNBS 12 for important prudential parameters, which is filed on quarterly basis. Again, this is CICs focused only. The return contains data on adjusted net worth, provisioning, etc. So this return is filed on quarterly basis for CICs coming to prudential parameters. DNBS 13 overseas investment details, which is filed on quarterly basis for all NBFCs. All NBFCs, irrespective of category, business classification, asset size, shall submit information on their overseas investment and returns on quarterly basis. In case there are no overseas investment during the reporting quarter, a nil return shall be submitted. Moving on to DNBS 14 for P2Ps, regarding important financial and prudential parameters filed on quarterly basis, applicable only to NBFCs that are in P2P. The return is to be filed by NBFCs P2P and contains data on asset and liabilities, profit and loss, prudential parameters, etc. Moving on to Form A certificate, which is filed annually within 1 month from the date of appointment of statutory auditor. The certificate to be submitted by NBFCs regarding appointment of statutory central auditor, statutory auditor in prescribed format, as mentioned in RBI's notification on appointment of statutory auditors of commercial banks, UCBs, NBFCs. The requisite reference is provided. Dated April 27, 2021. So, and there is a Form B which is filed by the auditor on being appointed as an auditor for the NBFC. Moving on to FMR 1, these are fraud related returns that are filed. FMR 1 relates to report on actual or suspected frauds. And it is filed as and when such things come up. It's applicable to almost all types of NBFCs, and having asset size of 500 crores and above. It captures report on actual or suspected frauds in the organization. Coming to FMR 3, which is an update on FMR 1. If FMR 1 is filed for any particular fraud, then if there is any update on that particular fraud, then this FMR 3 return needs to be filed. Again, applicable to almost all NBFCs having asset size of 500 crores and above for any developments that happen for all frauds filed in FMR 1. Moving to FMR 4, it is relating to dacoities, robberies, theft and burglaries in any branches or organization. It's filed on quarterly basis, like almost applicable to almost all NBFCs having asset size of 500 crores and above. And it's one consolidated return for the quarter for any of these incidences. Now, apart from these filings, if the NBFC is listed, then the LODR related requirements will also apply. Now
Hi,
we
hi,
uh,
Hi,
yes.
Kinjal. Thanks, you covered everything. If you go to the serial number 1, I'll share some of my practical experience. What in terms of the returns and how this return can be
Yes.
referred by the auditors and RBI and everyone. So first of all, this all returns we need to file on the CIMS folder, those portal. So earlier it was like Cosmos, and then SBRL was introduced, and then CMS portal is introduced, and those all return filed by in that CMS portal. Now DNBS 1 return is cover. It's very huge return. It goes every quarter and needs to be filed by 21st, and this covers all the asset liability, various top 25 information in terms of the borrowings, in terms of the ICDs given, in terms of the lending book, in terms of the NP accounts, investment listing, and then there are movement of the slippages, NPAs. So those all information getting covered under this. If your NBFC having FDI inflows, then those information also getting captured in this. Then DNBS 3, which is which return is for the capital adequacy ratio, but also this return calculates the own fund, net own fund, and various concentrations which we have given to the group and non-group to the NBFCs. All those information where you have exceeded, say, 25%, 15%, 40%, those exposure with the name and PAN number they ask. Can you go to the next slide, please? Yeah, and then on the 4B is now this 4B return is a combination of two, which is one is structural liquidity and interest rate sensitivity. So basically, there are various buckets given, like up to 7 days, and then 14 days, and then 1 month, 1 to 2, 2 to 3, 3 to 6, up to 1 year. So main focus is up to 1 year buckets, where it's not expected to go into the any negative mismatch. And also, RBI asked to have the policy on this, that you should have bucket wise tolerance policy, where your mismatch should not uh, uh, go beyond that tolerance and everything. This is the return where in the RBI inspection also they focus, where they expect that the inputs of these returns should come without having manual intervention, and straight from the system. Kind of various buckets, where you break assets and liability into the various buckets, mainly for your lending book and the borrowings. Yeah, this is a acrylic return. So acrylic is obviously more than 5 crore exposure is there, but this return is also asked about to update the various information about the borrower, like their ratings, internal, external ratings, and then if any borrower you have declared as a willful defaulter, then you need to update that information. Asset classification of the borrower, like it's a SMA 1, SMA 2, NPA, provisioning what you have done against this, whether this exposure is secured or unsecured. So various information they ask on this. Next, please. This is recently introduced in last 1 or 2 years, weekly RDB return, where any fresh default by a single day, suppose 30th September was the due date, and the client has not paid the money, then this single day default also needs to be reported in this account. And this return is structurally, it is showing like any new default and any moving out from the default borrowers needs to be updated in the system. So this is also a weekly return, which every week needs to file by Wednesday, with the cutoff of the previous Friday. Statutory auditor certificate, now this needs to be taken in 5 days, which was earlier like 1 month. Now in the last 1 or 2 years, they have kept it 5 days. And this also gives the information like NBFC has the principal business criteria of 50% asset and 50% income. So statutory auditor in this return, they certify that what is the percentage of your financial income to the total income, and what is the percentage of financial asset to the total asset. So this and a few more information they are also capturing, like your exposure to the group companies, and your group NBFC's asset and liabilities, and all sorry, assets only, not the liabilities, asset information and everything. Yeah, so broadly I have covered, and only the RBI or any other party or auditor expectations are like this maximum inputs, which are very critical for the quality of the returns, should be automated. So should come from your source system or any of the system, but without having the manual intervention. One more information. I think it is not covered here, which is a liquidity coverage ratio. So it was introduced a few years back, where RBI has to maintain the LCR. That LCR every quarter end, NBFC has to publish on their website actually. So which is nothing going directly to the RBI, but NBFC has to publish every quarter to their website. Yeah, that's it from my side. Hemant, if you want to add anything.
No, you have broadly covered everything. So good, you shared all your practical aspects. This helps everyone.
Yeah, I would like to add a few points on the corporate governance side. In RB, we have to file a fit and proper certificate. All NBFCs are required to file a fit and proper certificate within 15 days at the end of each quarter, confirming that the directors appointed, the fit and proper guidelines has been followed for the directors who has been appointed. And as and when any events happens, like the change in directors, the change in internal auditors, chief risk officers, CCEO, dividend declaration of dividend, appointment of statutory auditors, designation of statutory auditors. For all these events, proper communication has to be made to the RBI, and whatever information that has been sought to the RBI has also to be provided. That is, apart from this list of statutory returns that we have to file, correspondence happens with RBI on an even-based basis also. So that I would like to add here.
Yeah, further,
and
any change in the director's details which you would have filed along with the fit and proper criteria that has to be updated to the RBI. Further, any branch closures or branch opening that also needs to be intimated to RBI.
Intimated to RBI.
And I think any change in rating also we need to intimate to the RBI.
Yeah,
Yes,
change
sir.
in rating.
Rating
Correct,
also.
you're right.
Moving on to the second part of the presentation today, which is the draft directions on lending to related parties. So on October 3rd, 2025, RBI released these draft regulations for public comments. Once that is done, then these will become applicable from 1st April 2026. It covers all NBFCs, including housing finance companies. Currently, the way it functions is that the NBFCs today follow Companies Act, RBI scale-based regulations, and LODR. And there is no kind of special disclosures, reporting requirements, approval thresholds, and audit and monitoring happening apart from LODR, Companies Act, and these regulations.
Kinjal, 1 minute. Here, somebody has put up a question. Please confirm the list of the returns to be filed by the unregistered CIC. Whether the unregistered CIC preparing the financial as per the index, whether the financial on ROC is AOC 4 or NPSC or AOC 4 SPRL. I think so long as you are filing the index, index will go in SPRL only. Am I correct? Because only AS goes in physical board, what you call, not XPRL, but otherwise it goes in XPRL. That's what I think. When you are covered under index, it goes always to the ROC SPRL. Although this is not the subject matter here. That's what I think. Am I correct?
So correct, sir. I think it would not be AOC for NBFC, but AOC for XBRL only, which is required to be filed by them. I don't understand what is unregistered CIC. I mean, CIC, if it's a CIC, it would be registered with RBI.
Yeah, I don't think there is any unregistered CSC, but the CSC it is always registered with the CSC with RBI only. I'm
So
not
the
very
moment
clear
the
what
company is identified as a CIC, one has to get themselves registered actually.
Correct.
So then there it triggers the reporting requirements.
If you are a holding company, and you are not registered as CIC, you cannot say that I am unregistered CIC. You are just a holding company of all the subsidiaries.
Correct.
You may be meeting all the criteria.
There are compliments have come actually. It's a very good presentation. There is communicating to all the panel members. He's also saying, could you please the PPT? PPT is not shared as we have been telling in the past also. But whereas the recorded webinars will be available on the YouTube, you can actually get it. It will be disseminated immediately within 2-3 days of the end of the webinar, which you can actually access. Yeah, go ahead, Kinjal.
So there is one more question, which is what is the mode for filing of Form A? So Form A is with respect to statutory auditors, and we've emailed that to our regional office, to the SSM.
Yeah, correct. It's done through email only.
Yeah.
Okay. So coming back to the related party lending directions 2025. So these are on top of the already existing Companies Act, LODR, RBI scale-based regulations. And these directions essentially consolidate the lending to related party requirements into this one particular circular. It has actually borrowed various definitions from Companies Act to kind of specify what it means in this context.
Yeah,
And
currently
now-
it is governed by this RBI circular on loans and advances regulatory restrictions dated April 2022 actually. So this proposed draft is expected to replace that circular as and when it becomes notified in April 2026. Yeah, go ahead, Kinjal.
He has come back on the CIC. He says CSC can be unregistered with the RBI if it is meet with certain criteria. That is what he is actually saying. If there are any filing done through the Dutch portal of RBI.
I think if it is unregistered, you will not be enabled to file any returns through the portal, because every NBFC registered with RBI gets a registration number actually and a certificate, including this type or category of NBFC which it is.
I am little bit confused here, because when he says it is not meeting with a certain criteria, that means if the CIC criteria is not met, then there is no question of getting the registration done at all. There is no question of unregistered or registered. Either you get registered or you are not required to register. I think that's what I understand, if I correct. Again, I don't know. There is one more thing has come here. CACs with the asset sites of less than 100 crores.
No, he's giving the definition of CIC and what RBI norms specify. Yeah, go ahead.
Okay. Okay. So whether it is accessing the public funds or not with the asset loss of 100 crores and actually above, and are accessing the public funds, are not required to register with the bank under the section 451A of the RBI Act 1934 in terms of the notification. And the DNPS so-and-so is given the circular number dated so-and-so and will be termed as a unregistered CICs. That's what
my
he's saying.
understanding is that as long as you're not registered with the RBI, there is no need to file any supervisory returns.
Correct. In fact, you will not be able to access the portal at all.
Yeah.
Because
Right.
unless you have the identity, then only you can access. Otherwise, you cannot access. That's what it is actually. Yeah.
Are there any more questions on this, or should I continue?
No, that's all. Nothing.
Okay. So coming back to related party lending, NBFCs are permitted to let their existing related party transactions not in conformity with these directions to either run off till maturity or 1 year from the date of issue of these directions, whichever one is earlier. So there's a cutoff of 1 year, either that or till maturity, whatever related party transactions and contracts you already have. The NBFCs can continue with that, but post 1 year, these directions need to be followed for all of these existing related party transactions, whereas all new related party transactions must be following these directions. Now, the circular defines the directions define related party. It is an entity where a related person or relative of the related person is a partner, manager, KMP, director, or a promoter, or an entity where a related person or a relative of the related person is a shareholder with more than 10% of paid up equity share capital or holds paid up equity share capital of rupees 5 crore, whichever is less. Thirdly, an entity where a related person or a relative of the related person is having control, whether singly or jointly with another person. Also, an entity where a related person or a relative of the related person controls more than 20% of voting rights on account of ownership or through a voting agreement or through any other arrangement. Further, also an entity where a related person or a relative of the related person has the power to nominate a director to its board, or an entity which is accustomed to act on the advice, direction, or instruction of a related person or a relative of the related person, or an entity where a related person or a relative of the related person is a guarantor or a surety, an entity in the form of a private trust where a related person or relative of the related person is a trustee or an author of a beneficiary, or an entity which is related to the related person as a subsidiary or a parent company or a holding company or an associate or joint venture. Now, this is a inclusive definition for a related party that is specifically, provided in the circular that actually defines related party under these directions. There's also a proviso to this that the government of India or state owned for all the PSUs and government companies, it shall not be treated as related parties to a government-owned bank just by virtue of the fact that government has the common ownership or control of such entities. It also defines, so we are just looking at the key definitions that are there in this particular directions. It also defines related person, a person and the relatives of such a person, where the person is either a promoter or a director or a KMP of the NBFC, or owns more than 5% of paid up equity share capital of NBFC, or can either singly or jointly exercise more than 5% of voting rights of NBFC on account of either ownership or voting agreement, or through shareholders agreement, or through any other arrangement, or can through an arrangement with NBFC nominate a director to its board, or either is singly or jointly in control of the NBFC or is a group entity of the NBFC. Now, this circular borrows the definition of the relative from Companies Act, Section 277 of Companies Act, mentioning that anyone who's related to, if they are members of the same HUF, their husband and wife, one person is related to another, as a father, mother, son, and this includes all your stepson, stepmother, stepfather, son's wife, daughter, daughter's husband, brother, including stepbrother, sister, including stepsister. Now, the circular highlights just general principles related to related party. There must a board oversight to ensure that effective implementation of lending is to be done at the related part for the related party. Apart from that, it must be included in the credit policy of the company. The credit policy must properly define clear rules and safeguards for the related party. Then it also should have specific provisions for lending to senior officers of the bank and their relatives. Also, the policy should have a whistleblowing mechanism to encourage employees to communicate confidentially and without the risk of reprisal, legitimate concerns about illegal, unethical, or questionable loans to related parties, and also eliminate any quid quo pro arrangements if there are any. It also highlights that the policy must specify aggregate limits for loans towards related party. Within this aggregate limit, there shall be sub-limits for loans to a single related party and a group of related parties. These limits must be well within the extent of prudential exposure limits prescribed by Reserve Bank.
Yeah, this also covers under its scope the contracts or arrangements covered under Section 188. There are some threshold limits given under the Companies Act rules. No, that is also covered here. Of course, no process for approval has been specified in the draft regulation. Probably it will lead to a disclosure.
Somebody has actually put a question here. In case of the appointment of the statutory auditor in a NPSC, what are the compliances are required to be done? In fact, if I come to the compliances, first of all, the thing is the criteria, eligibility criteria as mentioned by the RBI is actually mentioned. That is one thing. If I'm correct, in the past also we discussed actually in case of the NPSC company, the appointment is actually done for the continuous period of 3 years tenure.
3 years.
As
Correct.
against the 5 years. That's what that we discussed in the past also. And plus, there is an annual intimation is to be given to the RBI. I think there is a particular form, I think they have prescribed, Form A or something like that. So they'll have to prescribe and then they'll have to adhere various other norms, etc. That is what it is required. I don't think
Partner
beyond
rotation
that,
is also there. Cooling off time period is also there.
yeah. And another thing is there, only thing is the joint auditor provision is also there in case of where the asset exceeds about 15,000 crores or something like that. That's what it appears to be. So that is the thing. As you rightly mentioned, the cooling period here, I think if I'm not mistaken, the cooling period is about 6 years, I believe.
Yes.
Yeah. Apart from that, I don't think any other compliances are called for actually here.
Yes, sir. Prior intimation is not required to RBA. Other than that, you have to follow the Companies Act compliances and procedures.
Yeah, that is the
Filings,
Companies
that-
Act compliances is anyway
that you
going
have
to
to
be there
follow.
because all the companies are
Yes.
incorporated in the Companies Act.
Yes.
Because in addition to Companies Act, whatever the sectoral regulations are there, that is also required to be followed. That is the only criteria here.
Yes,
And
intimation
here
needs to
second,
be provided.
yeah. One more question has come. What are the limits laid down for the prudential norms? Can you please let me know? I think this has been discussed in the past also, no?
So it is 25% of NBFC's own funds and 40%, single borrowing limit and group borrowing limit is 40%.
That's all. Yes, Kinger,
But
you can go ahead.
only Hemant is this limit is not applicable to the group companies.
Correct.
Your own funds only you need to monitor. It should not go beyond the regulatory requirement.
Agree.
Do debenture trustee who has the right to appoint the number of directors as per the regulation 62(1)(a) also form part of the related party?
So that is only attracts only when there is a default, event or default happens, then only they can appoint. Otherwise, they don't have any right to appoint directors in the company. So at the time of event of default, they will be appointed.
Yeah, Hemant, the question seems to be, what if the debenture trustee is a related party, whether he can...
Related party or not, that is the question.
That is
Suppose they appoint the director, whether it's a related party. That's the question.
So what I understood from here is, debenture trustee has a right to appoint nominee director. We saw a definition where, if someone has a right to appoint, has appointed nominee director is a related party. So only when you appoint a nominee director, you become a related party. That is what the definition says. But as per 62(1)(a), it's an enabling right where there is a default which happens. Then only this nominee directors can appoint. Debenture trustee can appoint nominee director. Otherwise, they don't have any right. They cannot appoint a nominee director on the board unless there is an event of default.
So that means, so long as the debenture trustee is there is no relationship is formed. Actually, when the nominee director is appointed, then that will be termed as a related party under that.
Correct.
Am I correct? Yeah.
Correct, sir.
Okay, thank you.
Okay. So these directions also specify materiality thresholds when it comes to these kind of transactions. It says that the loans to related party can be extended by NBFC in terms of their credit policy. Now, the credit policy, as we saw, the directions also talk about what should be included in the credit policy, which we saw on this slide. Now it should be according to this particular credit policy. Apart from that, in any personal loans to directors or KMPs should be subject to materiality thresholds, which is mentioned on the screen. They are free to lay down their own materiality threshold, but they have a ceiling that is specified in the directions, which is mentioned in the slide. For upper layer and top layer of 10 crores, for middle layer 5 crores, and base layer 1 crore. Now, loans and advances will not include loans and advances to a director and KMP against government securities, life insurance policies, or fixed deposits. These are allowed. Personal loans and advances to an employee director, which the employee director would have been eligible to borrow as an employee, subject to applicable prudential limits, loan to value ratios, as the case may be. Again, this is allowed. Further, materiality threshold may vary for different categories of loans to related parties. All loans above the prescribed materiality threshold shall be sanctioned by the board. So once these limits are breached, board approval will be required. NBFCs may delegate the above powers of lending beyond the materiality threshold to a committee of the board. And board can essentially give this particular function to another committee also if it wants. As regards the loans below the materiality thresholds, the same can be sanctioned by appropriate authority in terms of powers delegated to them. So this is according to however, NBFC wants to put in place processes for approvals of loans given to related parties below the threshold is as per the processes of the NBFCs and the person it appoints. The directions provide just general principles on how the lending should be done. Directors or KMP, whether a member of the committee or not, with a direct or indirect interest in loans to related parties, shall recuse themselves from deliberations and decision-making processes involving sanction, dispersal, and management of loans to related parties, including one-time settlements, write-offs, waivers, enforcement of security, implementation of resolution plans, etc. When it comes to monitoring of loans to related parties, banks and NBFC should put in place suitable mechanism for recording and periodically updating the list of related parties. Periodic reviews shall be conducted at quarterly or shorter intervals by internal auditors to check whether guidelines and procedures in relation to such loans are being strictly adhered to or not. Any deviations from the policy relating to lending to related parties shall be reported to the audit committee of the board directly. Any product, entity, or structure formed with the objectives of circumventing these directions through various means such as reciprocal lending or quid pro quo arrangements and identified as such by auditors of the bank or supervisory authority, an investigative agency shall always be treated as lending to related parties. So, in case of any loopholes in the internal processes of the NBFCs are discovered, through which such related party lending is done, then once these come into the light, they shall be considered as related party lending. It also identifies the role of statutory auditor. So the statutory auditors shall examine representative samples of loans to related parties of the bank with a view to satisfying themselves that the processes and procedures laid down in these directions have been complied with. All exposures to related parties, which are group entities of the bank and the NBFC, shall invariably be examined by the statutory auditor.
So just one thing to add here, Kinjal, when it comes to RPT, regulators want to see 2-3 things. One is how the loan was sanctioned, what was the requirement for giving that loan, who were involved in that, what was the purpose, and the most emphasis that they put in is on transparency, on the disclosure part. Where have you disclosed, whether you have disclosed or not, in your annual report or any other places. So that's how RBI always. I mean, that's a broad concept of all regulator, and RBI is it goes one level ahead. They also interact with auditors separately. That is what we have got to know. They discuss with auditors. They see what are the things going on. They check from the auditors. And one more requirement which is very different from other this thing they play a very important role. They think that audit committee is very important. They should function very differently, and they don't want management to participate in the audit committee. If they see managements are present, so they don't appreciate. So they want auditors and audit committee to play a very independent role in NBFC.
Audit committee deliberations are particularly important, and RBI goes through the same, and how the arm's length principle is established, and whether audit committee is satisfied with the arm's length principle that has been established in the transactions. That is being closely looked into, and also the credit rating agencies, they also monitor it. RPT is one of the key focus every year. So they will be having a separate meeting with the audit committee where they questions the audit committee whether you are satisfied with the criteria that has been put up for the related party transactions. So in that case, it is very much important. Audit committee, as Mr. Hemant said, plays a critical role. So proper deliberations is happening, and proper documents, proper records, and proper background is presented to the audit committee. That needs to be ensured so that they can make a critical decision on this.
Now, another thing is that when you come to the related party transaction, if it is a listed company, then it is also said all the related party transactions are required to be approved only by the independent director of the audit committee.
Independent director can only approve. Yes.
Yeah, that is what the requirement is there in the listed companies.
Yes.
So when only the independent director can only approve of the audit committee, then they got a larger role to play in understanding whether it's arm's length basis, whether it's the ordinary course of the business, whether it is within the norms, etc. They have to do a lot of job. Yeah.
Yes, in case you have a related party transaction with the group entities, then risk management committee also plays a role, because the group entity transactions, whether the group entity is solvent enough, whether the group entity, holds a suitable strength to carry out these transactions, that also need to be analyzed. The risk aspects of the group entities also needs to be analyzed by the RMC in case you are having related party transactions with your group entities. In case of it is group entities, it is more closely monitored by the audit committee, since it is within the group and there is no illegal transactions or cutting that is happening. That needs to be ensured by the audit committee. So related party transactions are very important and needs to be scrutinized really, effectively.
There are two more questions have actually come here. What are the
Before
detailed to?
before
Yeah.
before we take the questions, just one more point.
Yeah.
So when it comes to these kind of related party transactions, directors and KMPs will give an annual declaration about all loans availed by them and their associated entities from the respective bank or NBFCs or its group entities. The direction doesn't specify any kind of format or any kind of uh, you know, place where this needs to be provided, either annual report or not, but this kind of declaration is required from directors and KMP.
Okay. Somebody is asking, what are the details to be provided in the Prava portal of RBI?
So Prava portal is for making some applications that we require to make to RBI. So it's they've made a single window interface where we can directly make applications to RBI through that portal, centralized platform.
Okay. There's another question which has actually come. We want to delegate some powers in line with the section 179 3CJE, that means of the lending or investment. Section 179 states, board shall in its meeting appoint the lending and investment to be made by a company, or they further delegate to the committee of the directors. Now, can a committee of the directors consist of the credit head of the chief operating officer, of the investment head, and a member of the committee?
See, in NBFCs, usually the power to sanction loans is delegated in multiple ways. Some companies give the power to a managing director with certain threshold limits. They do it that way. The managing director takes a call and gets reported to the audit committee, board, risk committee, and all that. Certain companies have credit committee as well. Credit committee is usually a subcommittee of the directors, and internally at the management level, it is only the CEO or COO and CFO makes a recommendation to the credit committee for any proposals, and credit committee approves the same. That's how it happens in a practical sense in any NBFC actually.
Now, in
So
this
if you are
question,
going to call it as a subcommittee of the board, then other than a director, no person can be a member of the committee.
correct. That's what the point I was coming. Because when you call subcommittee of the committee, then it is only the directors, nobody else. As he said here, some of the chief operating officer or the investment head of a member of the committee, they are not being the director, they cannot form a committee. That's what I think. In
Yeah.
fact,
So
really, even under the LODR regulation also, only in case of the risk management committee, the senior personnel who are not the board member can be included. All other committees, only the directors are to be included. That's what I understand. Yeah.
Correct.
So here under 179 there are three delegations that we can do. One is to the committee of directors, second is to the managing director, and third is to the principal officers. Okay. Now these people will be treated as principal officers, and you can delegate to them, but it would be delegation to the principal officer, not it would not be committee of principal officers, but it would be principal officer that we have delegated. So that is how it would be. So your low lending policy metrics can have all those what kind of what at what level these people can exercise the power of lending. So you may say your credit head would be having a power of so much, or your CEO and credit head together would be having a power of so much, where both are required, or your investment head can have a power to give a loan of X amount. So that is how loan metrics can have. But when you say it is a committee, it has to be committee of directors under 179.
Somebody is asking a question. There is not required to access the Prava portal currently. only for this compliances will they be required to register?
On Prava portal, if I'm not wrong, you don't have to register. Anyone can access Prava portal, because it's a place where you're making an application to RBI for seeking some approvals or some registrations. It's not
Okay,
for
so
regular filings that is there.
Okay, so registration is not called for. It can be just accessed.
Anyone can register, sir, on Prava portal. Even you and me can register.
Okay. Okay, Kinjal, go through.
Then it also highlights supervisory reporting, disclosures, and penalty. It shall report to RBI through Daksh portal on semi-annual basis. Details of loans, sanctioned, contracts awarded to, and arrangements made with related parties in the prescribed format. Any non-compliance with instructions contained in these directions. So the NBFC has to voluntarily come up with and report any non-compliances by them when it comes to these directions. Apart from that, banks and NBFCs will also disclose the information on loans to related parties and details of contracts and arrangements with them in their notes to financial statements. At a minimum, the information shall include the following information for the last 2 years. The aggregate value of outstanding loans to related parties, the outstanding loans to related parties as a proportion of total credit exposure, the aggregate value of outstanding loans to related parties which are categorized as special mention accounts and non-performing assets, the outstanding loans to related parties which are categorized as SMAs and NPAs as a proportion of the total SMAs and NPAs respectively, and amount of provisions held in respect of loans to related parties. Top 10 exposures to related parties where exposure shall include loans and advances, non-fund based facilities, investments, and positive mark-to-market values of derivatives and values of contracts and arrangements with the related party. So these disclosures essentially kind of shed light on the proportion of related party transactions with respect to the entire company itself. Now, any non-compliance with and circumvention of these directions shall result in imposition of penalty as deemed appropriate by RBI. These penalties may include imposition of monetary penalty, requirement of full provisioning, directions to conduct staff accountability exercises, forensic audits, restriction and other supervisory and enforcement actions as deemed fit by RBI. So the full power has been given to RBI to act in the manner that it deems fit when it comes to any non-compliances with respect to these directions. So with this, we come to an end to this part of the presentation. If the panelists want to say anything or have any inputs before we end this.
I would like to ask one small clarification. Correct me if I'm wrong, because maybe I'm not very sure about it. Because while going through the NPSC and also what do you call this mutual funds, I actually see there is no what you call systematic investment plan is offered by a NPSC, which is actually offered for the mutual funds. First of all, that is my understanding. Correct me whether my understanding is actually correct. Second thing is that if somebody is interested in doing the systematic investment plan by utilizing the NPSC, whether it can be actually done. If that is the case, how it can be done? Because in the mutual fund, what happened? They offer actually systematic investment plan. NPSC, I understand they don't offer as such actually. So I don't know.
Yeah,
I'm just trying to find out. Yeah.
NBFCs as a fundraise mechanism, they only do NCDs.
Okay.
Or equity raise they do, and commercial papers and bank funding they do. As you said, they don't offer any systematic investment plans, because I think that from the very nature of their business also, they wouldn't be permitted to get into all that, because their main business is lending. Fundraising is only the means to the end.
Just to add here, sir, if it is a deposit-taking NBFC, they do have recurring deposits where you can have monthly deposits like an SIP, where you can put money with a amount that you have decided. It's a pre-decided amount, that you can invest. But it is only for applicable for deposit-taking NBFCs. Other NBFCs don't. They can't.
So that means if my understanding is correct, correct me, because I don't know, I'm still thinking, I'm trying to evaluate. Suppose I wanted to actually do some sort of the systematic investment through the NPSC. I think I will definitely look upon in two ways. One way is probably either directly investing it in the NPSC by purchasing the stocks of them if they are listed regularly. That is number one. Number two is through utilizing this deposit method second way. That is the only way we can do it actually. In identifying the larger NPCs, etc. That is the only way I can actually do it.
So, sir, certain NBFC come out with the public issue of NCD also, where they give some coupon. So that is also one way to participate by the public in the retail or HNI category through that mechanism.
I was actually thinking the systematic, the stock purchase, something like, either Mukut Finance or Shriram Investment, etc. and all those things. Like that, if you want to do it. That's what it was in my mind.
Even privately placed NCDs are listed actually. You can buy it in the market.
Okay.
But the float or the availability may be low because it has got certain restrictions as to the number of people to whom it can be issued. But still, it is listed. Some of the major NBFCs, privately placed NBFCs, are listed as well.
Yeah. Now I'll over to the panelists before we recapture whatever we have done in the last 2 months. If any of you would like to share, add some things, you are free to welcome. Any of you.
Regarding this board and its committees, sir, one thing I would like to add, which the RBI has been very particular in their recent inspections and all, that is the deliberations which has been happening in the board and the committees, especially in the board, in the audit committee, risk management committee, IT strategy committee, nomination and remuneration committee. So these committees, whatever the deliberations that has been happening in this committee, that needs to be properly recorded and properly minuted, because RBI has been very particular in about this in the recent years. So that is to ensure transparency, that every strategic decisions that has been taking place in the company is going through proper monitoring by the appropriate committees. That needs to be ensured. So that is a very important thing that we have noticed in our recent observations, and in the recent inspections report also. So that is a very relevant point here that I would like to mention. So the company has to ensure that the audit committee, RMC, IT strategy, everywhere, that it has industry experts who can actually cut into all those points that has been presented there, and they can contribute very well to the management, and they can provide their own inputs that goes into adding value to the company. So in that case, all these committees and its deliberations holds a key aspect in the regulatory framework of NBFC.
Yeah, to supplement what Ms. Sudhya said, drafting minutes is very, very, very significant and important work in an NBFC, because for RBI, when they come for the inspection, everything they infer only through the minutes in terms of whatever governance mechanisms you have. They look at the minutes as the evidence for those aspects actually. So however voluminous or lengthy your minutes, RBI always says that they still feel they need more to be recorded actually. So they always look at board and committees as the ultimate governance people for the NBFCs actually. So their deliberations, whatever they have commented, suppose if you in the minutes you don't write anything told by an independent director, they usually question why no independent directors has said anything. Probably they would have said you would have missed it to record it. So the minutes have to be recorded in a very, very elaborate manner in an NBFC.
Additionally, just to add, even policies also play a very important role in NBFCs. So apart from minutes, they also go through the policies, and they see whether your policy are updated, and your whatever you're practicing is there in your policy. I remember one of the interaction which we were just discussing with our internal group of compliance officers, and we found that they were doing something additional, which was really better for the NBFC and all. So RBI said that you have not put these things in your policy, which is which had to be part of your policy. Though you are doing something good, but it's not in your policy, so it should have been mentioned. So that is how RBI ensures that policy should be very well documented, and even SOPs are very important when it comes to NBFCs.
I am 100% in agreement with the Hammer, because there is always a saying, it is not only justice done, it should be shown as justice seems to have been done. So that means you have to display actually what you are doing it.
Correct.
I am actually remembered of the policy, ISO 9000 policy. It actually says it's only one principle. Do what you say what you do. That is what it appears to be. Yeah.
Yes, sir. Please put it in the policy, whatever you can do. If you feel you cannot do, please don't put it in the policy, because the policy document, that is to be followed word by word. What is there in the policy documents, that need to be followed word by word. You can't deviate from that. So if you cannot do something, don't put it in the policy document.
So something addition on the RPT from my side is RPT has been covered by like Companies Act as per the accounting standard also in India. There is a SEBI LODR also which covers, and now this RBI is also getting covered. The basic fundamental the rules, or we can say governance is very important to maintain this, and critical part in this RPT is first of all the identification of the RPT. So many a time the organization faces challenge to identify related parties. Then once it is identified, then people need to be has the enough understanding that transaction of what material amount are allowed with say whose approval, like shareholder approval will require, or audit committee approval require, or board approval will require. And the third is the continuous monitoring of those transactions. So many a time it happens like in the big organization, sometimes transaction doesn't get covered from say compliance eye or the finance eye, because maybe it happens from the front office, example, with some related party. So which many a time it gets covered as a post facto, but not, and which might require prior approval. So those kind of awareness is very much important in the organization, and where it awareness comes with the policies, training, and system in place. This is my understanding is, and the very critical part is reporting. So after all the like suppose we do the we take the approval, we do the transaction within the limit, but if we miss the report the transaction in say in the related party disclosure in the financial, or to the say in the returns to the regulator, or to the audit committee to in the meetings, then there is also a problem. So systems and processes are very important to address these things, and trainings, because trainings required at each level, because people should be aware enough that these are the related party transaction and what needs to be done with this transaction in terms of reporting, or in terms of data management.
As you rightly said, there's one more thing. Under the Companies Act, reading with the accounting standards, all the related parties' names are to be actually displayed in the annual financial statement, irrespective of whether you have the dealings or not in dealings. If you actually go through the financial, which is actually published by the company, you will see actually the related party names are actually appearing, that is required to be displayed. That means, first of all, whether you have a transaction or no transaction, that is apart. As you rightly said, identifying the related party is one thing which is called for. And again, accounting standard call for the disclosure of the related parties in the financial statement itself. So once that job is done, then whatever the transaction, other thing and all automatically will cover. That's a check which will happen. That is one. And second thing is, as you rightly say, I think between the regulators, the harmonization is taking place in bringing out the common, related party transaction under the Companies Act or the LODR regulation, even under the RBA. That is what it appears to be. Because as of today, there are certain disharmonizations are there with the different regulators. Probably that will get harmonized in line with all the regulators together. That's what I feel the days to come. Yeah.
So these related parties, would like to say one point that generally, it's a good practice to take note of the list of related parties every year during the first board meeting, as well as and when there is a change. As a practice, we do it actually. That helps to keep updating your related party list in the database so that there is no inadvertent transaction which happens.
Yes, there are an omnibus approval is taken of the possible related party transactions for the financial year. An omnibus approval is taken, and every quarter the status of the related party transaction against this omnibus approval is also being presented to the audit committee so that they are in track. And if there is a high value transaction, that is also presented separately. So that the audit committee is having a track on all the related party transactions that is happening
So,
on a
Shan,
quarterly basis.
sorry, Shan, can you repeat what you said? How you do it annually? Shanmuga, can you repeat?
Sorry?
Can you repeat? What you do annually? What you said? You place what the entire related
No,
party
the
list.
related parties list we identify during the year beginning, because we take the annual approval in March for the next subsequent financial year related parties. At that time, we also put out the list of related parties we identify based on the disclosures given by the directors, as well as definition under Companies Act, as well as under Ind AS. And every quarter we keep reviewing as and when there is a change in disclosure, we keep updating, and we only the change we put it in the subsequent meeting so that the list is always constantly updated. Because unless you communicate the list to the finance team, there is a possibility there can be a miss out in terms of transaction which may go without the prior approval actually.
Right. Thank you for your inputs. We will now move to like a quick recap of our entire NBFC webinar series that has taken place over the last 2 months. Starting with our first webinar, which was on introduction to NBFCs, looking into concepts and relevance. We looked at why NBFCs matter more than ever today because of the scale of growth from 2 trillion AUM in 2000 to 43 trillion by 2024. NBFCs now outpace banks in credit growth at approximately 12% CAGR. They play a huge market role also today. They provide retail credit, microfinance, leasing, investment services, infrastructure funding, whereby they have deep roots in the financial sector of India. And they've also deepened our financial market in the country. They also now hold systemic importance. Large NBFCs, we have realized through the failure of large NBFCs like INFS, DHFL, where governance lapses destabilized not just the entity but the entire financial system at that point in time. There's also regulatory shift where RBI no longer sees NBFCs as shadow banks. They also instead they look at it as quasi banks expected to uphold banking grade standards of compliances and customer protection. The regulatory focus areas have been, KIC and customer onboarding, where unique customer identification code is mandatory. Violations in CKYC records and incomplete data among the most penalized lapses today. We also looked at fair practice code, recovery agent harassment, late night calls, reputational damage is being tightly regulated. Key fact statements must be transparently disclosed. All charges, hidden fees, and any kind of non-transparency is not tolerated anymore. We looked into outsourcing and fintech partnerships also, where NBFCs now are increasingly outsourcing underwriting and verification to third parties. RBI mandates that audit rights and contractual safeguards in all such arrangements. Then credit bureau reporting. Errors in reporting, repayment delays or defaults can cause customer distress and invite RBI penalties. Reporting timelines, monthly and quarterly, are now more stringent. Evergreening of loans, investments through AIF structures to recycle funds back to defaulting borrowers is expressly prohibited. RBI views this as systemic risk camouflage. Fraud reporting and committees. Fraud must be reported within strict timeline. Dedicated fraud monitoring committee. Committees are expected to operate under board oversight. These are the key focus areas that has been for RBI when it comes to NBFCs recently. We looked into different types of NBFC classifications also. NBFC can be classified in different ways. One is by liability, one being deposit taking NBFCs versus non-deposit taking NBFC. Second is classification by size for systematically important for all NBFCs more than 500 crores in assets, and non-systemic where you have less than 500 crores in assets. We can also classify NBFCs by activity, such as asset finance companies, loan companies, investment companies, core investment companies, infrastructure finance, MFIs, P2P platforms, account aggregators, mortgage guarantors, and others. This is according to the specific products and activities that the NBFC undertakes. It can also be classified by different layers. Now, this is mostly for regulatory purpose, why they have been, classified in this manner. One is base layer for NBFCs with less than 1,000 crore assets, middle layer, all deposit taking NBFCs, and larger non deposit taking NBFCs, upper layer, top 10 by asset size, and RBI flagged high risk NBFCs, and top layer, which is rarely invoked, reserved for NBFCs posing extraordinary systemic risk. In that session, we also looked at governance expectations from the RBI when it comes to board composition. At least one director must have NBFC banking experience. Mandatory committees, even private NBFCs must form audit, nomination, risk management, and ALM committees in the minimum. And these compliances increase as and when you go up in the layering that is provided by RBI. Chief Compliance Officer is mandatory with independent empowered reporting directly to audit committee. Chief Risk Officer expected in the middle upper layers with independent oversight. Loans to directors beyond 5 crores require board approval. Transparency is non-negotiable. Like I said, these regulations become more and more stringent as and when you go higher on the layering. We also discussed practical pain points, which is multiplicity of NBFCs and groups. RBI discourages layering of often and often directs consolidation of different NBFCs in the same group. Legacy compliance gaps, old unresolved charge filings, pending auditor changes, or unclosed loan surface during due diligence and audits, where you don't have any kind of prior record and things like that, which becomes kind of difficult to then navigate. Then principle-based regulation, unlike SEBI's prescriptive approach, RBI issues broad guidelines. NBFCs must assess the spirit of regulation, not just the letter. Audits as stress tests. RBI audits today are intrusive and thematic. From board minutes to MIS reporting, everything is under scrutiny for NBFCs. So RBI takes audits as a key, regulatory requirement. So for them to keep tabs on the functioning of different NBFCs and banks.
I would like to stress one important point here for company secretaries. Actually, RBI inspection could be one form of your performance review by way of observations in their inspection report. So you need to be extremely mindful of the role you will have to play in an NBFC in terms of reporting matters to be reported to the boards and committees, as well as how you structure the policies, how you record the minutes and all that.
Then we looked at the best practice, which can act as safeguards, when any incidents take place. NBFCs are encouraged to be audit ready always. Treat RBI inspection as ongoing and not event based, ensuring that there is compliance throughout. There should be integrated MIS, automate CKYC, fraud alerts, and credit bureau reporting. Board training, directors, especially independent directors, must undergo NBFC specific compliance workshops. Loan lifecycle compliance, link charges filing, satisfaction of KFS issuance directly into loan workflows, essentially integrating workflows throughout the entity. Using digital portals, Daksh and Prava must become routine compliance channels. Apart from that, we looked at strategic outlook and the road ahead for NBFCs. We anticipate that there'll be convergence with banks. Large NBFCs, such as upper layer, will increasingly be regulated like banks. Consumer-centric regulations. RBI's philosophy is clear: customer is king. Every guideline must ultimately, provide fair treatment and transparency to its customers. NBFCs must be highly technologically driven to provide them oversight and insights into their functioning. Expect more real-time reporting portals and cross-checks. And they are looking at integrating MCA's V3 with RBI data also. When consolidation push, multiple small NBFCs and groups will face pressure to merge for efficiency and regulatory clarity. So we are looking at, smaller, the industry to essentially integrate, where the smaller players move out of the market eventually, and bigger players essentially run the show.
Yeah, the
Then,
regulatory arbitrage between banks and NBFCs, at least between the middle layer and upper layer NBFCs, is narrowing down. By and large, the regulations will become uniform for those NBFCs and banks over a period of time.
Then moving into our second session, which was on Fair Practice Code and Internal Ombudsman, or IO. We looked at its evolution and significance, where FPC was introduced in 2006 for transparency, fairness, and customer protection. It looks into transparency and disclosures when it comes to loan application agreements and sanction letters in language understood by the borrower, key fact statements, mandatory disclosure of all charges, interest rates, and true annual costs. NBFCs cannot levy charges not disclosed in KFS unless explicitly approved later. Responsible lending, return of property documents within 30 days of loan closure, disclosure of complaint categories in financials, and prohibition on vague one-sided clause. Governance responsibility, RBI views FPC as a fiduciary responsibility of the board, not just compliance officer. So this essentially relates to all the loan sanctioning and interface with the customer, and how the NBFC takes responsibility to ensure that there's transparency between the NBFC and the customer. Internal Ombudsman, or IO. This is essentially for grievance redressal. The IO mechanism has been introduced to enhance customer confidence and ensure independent review of complaints and not resolved satisfactorily by the NBFC. IO functions as an appellate authority within the NBFC. All customer complaints rejected by the NBFC's grievance redressal team must be escalated to the IO before final closure. IO ensures fairness, timeliness, and non-discrimination in complaints handling. We looked at the implementation challenges also when it comes to FPC and IO. Digital lending and documentation. Participants asked whether sending loan agreements by SMS, email suffices, given that borrowers may not access links. Where it was clarified that mere dispatch is not enough. NBFCs must obtain acknowledgement and consent in the form of OTP, e-sign, or physical confirmation. Language and vernacular requirements. Questions arose on translating documents into multiple regional languages when operating across states. It was advised that vernacular documents must be accurate and in compliance. Compliance professionals should verify translations to avoid any disputes. Charges and penal interest. Concerns were raised on levy of penal charges at pre-closure and whether RBI caps NBFC interests. It was clarified that while there is no fixed ROI cap, charges must be transparent and not arbitrary. Then we looked into return of security documents. One of the participants asked if delay in updating CERSI despite returning original documents could attract RBI penalties. It was confirmed that NBFCs must ensure full compliance, including statutory filings. It was highlighted that FPC is not a checklist, but a trust-building tool with regulators and borrowers. Borrowers' protection is the central theme when it comes to FPC and IO, covering areas like harassment by recovery agent, hidden charges, lack of disclosure. Compliance with vernacular disclosures and KFS ensures informed decision-making by borrowers, reducing disputes. The IO framework adds credibility to NBFC grievance redressal, especially in retail lending, where complaints are very frequent.
Just to add here, Kinjal, RBI has also recently come out with draft IO framework, revised draft IO framework, which is also open for public comments. So if someone is interested,
Right.
maybe they can go through.
Then we move into prudential norms. We looked at why these are very important because now, since NBFCs play such a big part in our financial system, if anything goes wrong, the impact must be properly curbed. They provide credit to it also poses a systemic risk in terms of in any kind of failure of a large NBFC can disrupt the entire financial system. We looked at the evolution for the same, where before it was all one size fits all, but now they've come up with scale-based regulations. Um, and this is base layer, middle layer, upper layer, top layer, which we discussed earlier. Then we look into the IRAC requirements. IRAC requirements basically is the circular and master direction that looks into prudential norms. Um, it looks into leverage ratio, which should be less than 7 times for all NBFCs except for certain NBFCs. We looked into how income should be recognized for all lending that takes place. Income must be recognized only when actually realized, and not on accrual basis. So, in case any income is required, if any income is recognized on accrual basis already, then it must be reversed for all NPA accounts. Then, when it comes to investments, dividend income is recognized on cash basis, except post AGM declaration of such dividends. And interest on bonds accrues only if payments are regular. Otherwise, it should be recognized on cash basis again. Then asset, we looked into asset classification, which is classified into standard asset, substandard asset, doubtful asset, and loss categories based on repayment status. NPA norms, before it was 180 days, but now today an account turns NPA when it's overdue for 90 days. Then we looked into special mention accounts, SMA 0 being early warning, where that is overdue up to 30 days. SMA 1 is moderate stress for 31 to 60 days overdue, DPD, days past due. SMA 2 is high risk, which is very likely to turn NPA, which is from 61 to 90 days overdue, or DPD. This kind of highlights the warning signs for the NBFCs and banks. And if any asset is to be upgraded from NPA to standard asset, then it must be fully repaid. The borrower must clear all overdues and interest and principal for it to upgrade to standard asset. And not just any partial repayment will not, result in an NPA turning into a standard asset. Apart from that, if a customer defaults on one loan account, the entire customer holding all accounts with the NPA will be holding all accounts with the bank and NBFC will turn into an NPA. Further, we looked into provisioning requirement, where 0.4% is kept for standard assets. Standard assets are, the ones that have not gone NPA as yet. Loss assets will require full write-off of 100%, or 100% provisioning. Doubtful assets will require 100% provision to the extent to which advance is not covered by the realizable value of the security, that is unsecured portion. In addition to the above, provision to the extent of 20% to 50% of the secured portion shall be made on the following basis. So the period for which the asset has been considered doubtful, so, when it comes to up to a year, then you require 20% provisioning. 1 to 3 years is 30% provisioning, and more than 3 years is 50% provisioning. Substandard assets attract a general provisioning of 10% of total outstanding. We looked into capital adequacy and leverage. Minimum CRAR 15% for NBFC base layer and above. Leverage ratio, we covered max 7x of base layer, prevents overborrowing. Tier 1 capital, core equity capital plus retained earnings. It excludes intangibles and unrealized gains. All of this is important. Capital adequacy and leverage essentially talks about the strength of the NBFCs. It is required by rating agencies, lenders, and investors who are investing in the NBFCs to check, the solvency and the borrowing capacity of the NBFC. They look at capital adequacy ratios. It We looked into strengthened government and disclosures also. Upper layer NBFCs face stricter requirements. Risk management committee is mandatory for large NBFCs. Auditor rotation and enhanced disclosure, ensuring independence and transparency. And we looked at real-time reporting to RBI, including weekly SMA default reporting. Finance and compliance teams must work hand in hand, when it comes to approvals, board policy, and committee meetings, and it cannot be siloed when it comes to such reportings. A lot of the question answer session covered a few topics, including CRR, ESOP reserves, collateral valuation, securitization risk weights, NOF breach, dividend declaration. It was concluded that prudential norms are not just compliance checklists, but they are risk shields for NBFCs and the financial system. Then we move on to the fourth session that we had, which was on gist of scale-based regulations. We looked into outsourcing and related parties. Experts clarified that outsourcing to related parties is permitted, provided it is supported by board or audit committee approval and well-defined service level agreements. Such agreements must outline scope of work, data protection, confidentiality, audit rights, and termination clauses. However, core and strategic functions such as credit appraisal and decision making cannot be outsourced. Ultimately, accountability always remains with NBFC. This essentially highlights the limits to which the NBFC can outsource and how the final accountability is with NBFC only and no other entity. With effect from April 2024, RBI's new IT and cybersecurity directions require NBFCs to adopt vendor risk assessment, data classification, encryption, and access control in all third-party contracts. Institutions must implement business continuity and disaster recovery plans, conduct regular SaaS audits, and ensure IT is treated as a critical function subject to ongoing monitoring and audit. We also discussed digital lending framework. Digital lending has been placed under stricter supervision with NBFCs required to fully comply with Fair Practice Code. Loan terms, charges, and processing fees must be transparently disclosed. Recovery practices must remain ethical, and grievance redressal mechanism must be robust. Importantly, NBFCs are held responsible for borrower outcomes even when loans are originated through digital platforms. With all the fintechs coming into the market these days, this framework was extremely important. It holds the NBFCs responsible for outcomes of loans when they are originated through co-lending partners or other fintechs, when lending is done through digital platforms. When we looked at credit information reporting, RBI has tightened requirements for submissions to credit information companies. NBFCs must now report borrower and guarantor data on fortnightly basis instead of monthly. Regulators also monitor accuracy through data quality index, and penalties apply for delays in dispute resolution. This ensures that credit information remains complete, timely, and reliable for risk assessment. We also discussed Ind AS and financial reporting. Ind AS standards are mandatory for listed NBFCs and those with net worth above 250 crores, extending also to their subsidiaries and associates. Under this regime, provisioning is based on expected credit loss model, often resulting in stricter provisioning compared to RBI norms. Processing fees must be amortized over loan tenure, and fair value adjustments must be reflected transparently, aligning NBFC financials with global benchmarks. So India's reporting was much more different than what we were doing before when it comes to IGAP, where the concept of expected credit loss was introduced, and provisioning when it comes to loan assets must be done, and financial assets must be done basis that. Then we looked at project finance directions. From October 2025, project finance by NBFCs will be governed by a new framework. Repayment is capped at 85% of project life, with lenders required to maintain minimum exposures of 10% for loan up to 1,500 crores and 5% or 150 crore for larger loans. Delays in project commencement will attract incremental provisioning of 0.375 per quarter. The framework also emphasizes financial closure before sanction and mandates closer monitoring across design, construction, and operational phases. Project finance lending is separate from corporate lending and retail lending because and is uh, regulated through a different direction. As the lending process is relatively different, that depends on the stage at which the project reaches, and repayment is done according to that. We looked at additional compliance areas, including mandatory filing of charges with Oversight to prevent multiple loans on the same asset, compulsory disclosure of mortgage details, in-house finance advertisement, prohibition on NBFC entering partnerships or LLPs, and reporting of any change in credit rating to RBI within 15 days. Risk management committees are expected to provide meaningful guidance with a focus on early warning signals and stress testing. We looked at we understood that compliance is no longer a checklist exercise but means to build trust with regulators and customers. Company secretaries have strategic role in governance, particularly in structuring NCD issuances and engaging with rating agencies. RBI has moved towards real-time monitoring, analyzing returns, and issuing targeted queries to NBFCs. Overall, the SBR framework, scale-based regulation framework, represents RBI's intent to balance growth with governance, embedding transparency, borrower protection, and accountability into NBFC operations, thereby strengthening both compliance and long-term market confidence. Then our fifth session looked into IT governance, risk control, and assurance practices. Where we looked at audit readiness of the NBFC committee documentation.
Kinjal, we are already one ton, I think. So you need to rush up with the titles because since you are recapturing it, because already we are at 1 ton, I think. Yeah.
We looked at the IT governance and committee framework. We looked at forming IT strategy committee with minimum 3 directors, chaired by independent directors with 10+ years of IT governance experience. Meets quarterly to review IT strategy, cybersecurity budget, disaster recovery. Ensures IT is aligned with NBFC business strategy. IT steering committee, senior management-led support. Senior management-led supports IT strategy committee in project oversight, IT business alignment. CEO, business continuity when it comes to IT. Security, information security committee that looks at data security compliances. Then risk management committee should also look into the operations of the IT security committee, the IT strategy committee. It also reviews incidents, audits, and mitigation strategies for updating, for whenever incidences in terms of hacking and cyber attacks take place. CISO's role and cybersecurity role provides clear mandate. Appointment letters must explicitly state roles, responsibility, and technical expertise. Documentations, cyber resilience. We also looked into policies and frameworks required. NBFCs must frame and regularly update policies, including change and patch management policy to ensure secure upgrades without disruptions. Data mitigation policy, which looks into integrity, completeness, and audit trail during system migrations. Risk management policy, incorporating IT and cybersecurity risks reviewed annually. Information security and cybersecurity policy with clear crisis management and response protocols. Business continuity and disaster recovery policy, ensuring critical services remain operational during cyber attacks or disasters. Information system audit policy approved by audit committee, reviewed annually. We also looked into vendor and outsourcing risk. NBFCs must conduct due diligence covering financial stability, cybersecurity, maturity, processes, and operations of the vendors it takes on. And we're looking at more stable vendors with track record and that are sizable in nature. Source code escrow arrangements must be in place wherever vendors refuse to share source code for critical applications. Business continuity and disaster recovery. NBFC must have tested recovery mechanism to minimize downtime. Daily or periodic data backups must be done. BCP ensures uninterrupted operations during disruptions, while DR focuses on swift restoration of systems and services. Independent directors with IT expertise are difficult to find. Becoming an challenge for all the companies. Compliance requires cultural shift beyond company secretaries, IT teams, and senior management. And these officers must update themselves when it comes to all the IT requirements of the company. Documentation burden. Even strong system may fail regulatory scrutiny if not properly documented. Cybersecurity as survival. Experts noted that cybersecurity is no longer a technical issue; it is a business survival issue in case of any attacks, hacking, incidents, etc. Then on to our sixth session, the previous session, we looked into KYC and AML norms for NBFCs, where we looked at purpose of paperwork when it comes to KYC, audit trail requirement, and continuous learning when it comes to FATF standards, technology-driven processes. We looked at the regulatory framework and key concepts. Where KYC AML essentially takes its roots from Prevention of Money Laundering Act 2022 and the RBI Master Direction on KYC. It requires customer due diligence. It highlights several definitions which we covered in the session, which is customer due diligence, beneficial owner, who is an individual who ultimately owns or controls more than the prescribed percentage of the entity, any suspicious transactions that that are unusual, complex, or inconsistent with customer's profile, and central KYC registry, which is a centralized digital repository of verified KYC records for financial institutions.
I think Kinjal, you need not read everything. Just heading is enough, I think, because we are already 115 or something like that. I don't know anybody will be raising the hands, etc. That also we can check it out. Just take us only to the headings. Yeah.
Okay. We looked into governance and oversight roles also when it comes to designated director, responsible for ensuring compliances with PMLA, principal officer, who manages day-to-day AML function, and segregation of roles between separate individuals to ensure independence and oversight. Then KYC framework pillars were identified, which is customer acceptance policy, customer identification procedure, risk management, and ongoing monitoring. We also looked into Aadhaar and privacy safeguards, where we discussed the Supreme Court ruling of 2018, where NBFCs cannot mandate Aadhaar but may use masked Aadhaar, and staff in branches must be trained to collect this masked Aadhaar, and alternative documents such as PAN, passport, voter ID must remain valid for KYC verification. Digital and simplified KYC, we looked into video-based customer identification, which is now permitted by RBI. Simplified accounts, which are lacking full documentation, with a capped validity of 12 months. Concurrent audits required for any account activation, reporting obligations under PMLA, including cash transaction reporting and suspicious transaction reporting. No nil reporting required, but RBI expects automated alert system that flag reportable cases. Vendor outsourcing and group reliance. While NBFCs can outsource within the corporate group, NBFC must ultimately remain responsible for KYC accuracy. Record retention and technology. All transactions record must be preserved for 5 years from the date of transaction. Identity documents are to be retained for 5 years after cessation of the relationship. Then We looked at the complexity of regulation, which was, fragmented updates that and circulars that keep coming, documentation fatigue, non-documented processes fail regulatory tests, even when control exists, behavioral lists. When it comes to cash transactions, suspicious transactions, technology as a compliance enabler from digital onboarding, it's crucial to uh, include and align technology for all the KYC and AML requirements. When we said that KYC and AML is very important for governance when it comes to NBFCs, and RBI's expectations are very high when it comes to ethical conduct and technology inclusion and transparency when it comes to KYC and AML requirements. With that, we come to an end to our NBFC series for our webinar.
Thanks a lot, Kinjal. I liked it very much. The last portion when you recaptured everything at one go, it will be very useful to the participants. And really speaking, today's sessions, it throws a lot of things on when it's come to reporting, nil reporting, and the framework, related party transaction formulation. Every one of you, I'm personally thankful to each one of you. You added value really to this session. It was a great learning. I'm sure it is not only for me the great learning, it is the great learning for the other participants also who are there. I think it was a very useful session, I would say. I think, Kinjal, you can stop sharing the screen. I'll check up if any participants are there. I don't think anybody is there actually hand risen, because so far we have answered all the queries and questions. There is no hands are risen actually. I think probably we can close the session at this time. We are already running out of the time, 1:20. I think any of the last word from any panelists would like to add, I leave it to you. Then we can close the session.
I think it's a good discussion we had in terms of RBI reporting and all that, and I also feel like this summary of the earlier sessions, that was a good one. So thank you, Mehta and Mehta, for this opportunity. It is indeed a learning opportunity for all the panelists as well, I think. So it's a kind of recap. We also brushed through the provisions and all that. Thank you, Pala sir. Yeah, go ahead, Eamon. Sorry.
Yeah, sorry. Rightly said, it was learning session for us also. So I had recently read one sentence which says, "Insight becomes impact when it's shared," and Mehta and Mehta, has made this true. So it's been really pleasure being part of the entire webinar series, not just as a panelist but as a fellow professional learning, together that we did. And each session felt like a masterclass in collaboration. I genuinely enjoyed sharing my thoughts, hearing diverse perspective from you guys, and picking up insights that I will carry on with my journey. We have not met Shanmuga and other panelists in person, and even the participants we have met virtually. But I would like to meet you guys in person and have a cup of coffee or tea. And when we say it's like just last sentence, NBFCs are non-banking financial companies, but in this kind of the series that we had, it was like non-boring finance conversations that we had. So
yes, well said, that one. That's a good one.
Absolutely right. Well said.
Yes, this is from my side. Thank you.
Well, thank you, sir. Thank you for this opportunity. I would like to thank Mehta and Mehta for this opportunity. The seminar was really enriching, and it was really a learning platform for me. And one thing I would like to add is one news that is in the Economic Times, that is Reserve Bank of India is planning to undertake the exercise of consolidating the regulatory instruction that they have been issuing up to October 9 into 238 master circulars. So in that process, they are planning to repeat approximately 9,000 circulars, which is no longer in use. So RBI is also planning for a consolidation of all their directions. I think that's a good move that helps in easier tracking of the regulations, I feel. So, Mehta and Mehta, I have one suggestion for you. I don't know whether you have done it or not. So, regarding this policies, the policy framework, what are the policies that are mandatorily applicable to NBFCs across various regulations, master circulars and all? If you can consolidate that, and what are the policies required and what are the mandatory things that are to be mentioned in the policy? Is there any webinar that has been conducted on that and separately for the policy side? in that case, you can think about that also, because the policy is like a charter for NBFCs. So it's my suggestion from my side, sir.
Thanks a lot. We take a note of it. Definitely, we will examine. We'll definitely do it, because ultimately, as Hemant said, at the end of the day, it is actually sharing of the knowledge rather than holding the knowledge. That is the thing.
Yes, sir.
I think some cross talks are happening. Please put on the mic. Please mute your mic. Yeah.
So I think Vishal is in office, so he has just opened his mic.
Okay. Yeah. Wonderful sessions, to be very frank with you. Wonderful panelists, wonderful audience. Great session we enjoyed. With this, I think we close. In fact, today's session, I never expected it will go such a long actually, because we thought, but it is already 1:20. That itself shows what is the importance of the session, as you rightly put, Hemant. It's really useful. Thanks a lot to you. Looking forward to more association in future days to come. My special thanks to Kinjal once again. Already there are appreciation in the chat box saying, your recap, etc. is really good. It's a wonderful session. You have done a wonderful job, Kinjal. My appreciation personally to you. With this, we close the session.
I think
Next week,
Vishal
we'll
wanted
meet
to
at another
say
session.
something.
Yeah.
Vishal,
Yes.
you wanted to close.
All have said this. It's a kind of repetition only, but it was very good session. I was there in earlier two session also, and this session also wonderful presentation given by Kinjal. The coverage was very wonderful. And it's very much useful to all the participants. And as we already said that it's learning for everyone. It's like learning never stop at any level. So the kind of question also people put, and to answer that and get the answer is also kind of recap for everyone. So thank you very much, sir, to the entire team of Mehta and Mehta. Thank you very much to invite me.
Thank you.
Thanks a lot. Have a good weekend.
Yeah, thank you.